Good afternoon, everyone. We'll give it another minute, I think, just to see if we have others that are joining us as we speak. And then we will start off with our webinar this afternoon on the home buying journey. Okay, so I can see that we've had quite a few people join us this afternoon. So good afternoon, everyone. It is wonderful to see so many of you taking the time out today to join us. I'd like to welcome you all to CiC's session on the home buying journey. This is part of our financial wellbeing webinars series. My name is Ivy Murdoch and I am the financial wellbeing stream co-lead here at CiC, and we're thrilled to continue this series with this webinar. Our host for this session today is Darren Ford, and the aim of the session is to be as interactive as possible. So we do invite you to use the chat function. Let us know where in the world you're watching us from, comment, post any questions as we go through. We have set aside a good amount of time towards the end of the session for Darren to respond to all of your questions and comments, but if we can't get to all of them because there are too many of them, we will then follow up separately with answers to questions. Now, just a very brief note around today's session. So mortgages and home buying vary greatly, both around the world and within the UK itself, and it can be quite complex. So we will focus on England for today, and we will post some resources in the chat that are relevant to the devolved nations of the UK. And Darren will be providing information and guidance during this session. The reason for that is that financial advice is regulated and requires a deep understanding of personal circumstances to be able to be delivered. But with that being said, I am, however, very confident that there will be tips and tricks and best practice that will be universally relevant to all. So just to add, from a housekeeping perspective, the session is being recorded. So if you'd like to watch it back yourself, or if you have any colleagues that haven't been able to join us this afternoon that would like to watch the webinar, please do let them know. And without further ado, we will start the recording, and I will hand over to Darren to take us through the home buying journey.
Hello, yes, good afternoon, guys. So, yeah, welcome to the home buying journey from dream to doorstep. I'm going to attempt in this presentation to try and make mortgages sound interesting. I appreciate it can be a bit of a dull subject, but hopefully whether you're a first-time buyer or whether you're someone looking to remortgage or move home at any point in the future, this should hopefully be able to help you understand the process and the timeline of what home buying is, whether you're a first-time buyer or, yeah, you're a seasoned professional. So, yes, thank you very much to that introduction. My name's Darren Ford, and I am a qualified independent financial advisor and mortgage and protection broker. So, yeah, this webinar is solely going to be about the home buying process and the journey. So I help clients, first-time buyers purchasing their first home, existing seasoned homeowners looking to move or remortgage, and buy-to-let and property investors. And also insurances that come alongside those things. So life insurance, income protection, and critical illness, I always strongly talk about because they're important. When you're owning a home and you have a mortgage, you want to make sure that your finances are protected and you're protecting your partner and your spouse. So those things are always really important to sort of talk about when you're getting a mortgage. So then, I've separated this presentation into 4 parts. First is getting mortgage ready. What do we need to do to get ourselves into a good position to be able to get a mortgage? Again, whether you're a first-time buyer or someone that already owns a home and looking to remortgage. What are the actual options available? What's the timeline, the home buying and remortgage process? And then importantly, well, what's this going to cost me? What are the costs involved? So first and foremost, we need to understand our budget. Now, budget is really important when it comes to personal finance, not just obtaining a mortgage, because we all need to know what's going on with our finances. You know, are we on top of everything? But when it comes to applying to a mortgage, we need to understand, what are these banks looking for? Well, there are a variety of things that they are going to need to see to be able to decide whether they are going to give you a mortgage or not. So when we provide evidence to these banks, mainly bank statements and things like that, they're going to look at your direct debits. They want to look at your standing orders. They want to see what sort of income you've got and what sort of outgoings you have. So they want to see if you've got big payments, unusual payments, some of these things that we can probably explain easily. Don't forget, you know your personal finances, they don't. So we're almost in a position where we have to sell ourselves to these banks sometimes, because they don't know you. And until we provide this information, they're not going to know you. So important things that they look at, like your spending habits, like your debts, your debt repayments higher than your income. Have you got a lot of gambling going on? They don't want to risk their money. At the end of the day, they're going to lend you, a large sum of money. And normally this money is the biggest debt that you're going to have. They want to make sure they get that back. So these are sort of things that they need to weigh up before issuing a mortgage to you. And there's a variety of ways that you can do your budgeting. You can use a typical spreadsheet, Excel or Google Sheets to list your income and your outgoings. You could do it manually if you prefer. Print 3 months of your statements, highlight non-essentials, look at all those coffees you're spending or the food when you're going to work, and you can spot all the red flags by doing that and just highlighting it on those bank statements. Or you could use an app, which in this day and age, a lot of banking apps will have spending breakdowns. You've got the likes of Monzo, Starling, Revolut. They're perfect in this situation because you're going to have savings pots and spaces, and each income and outgoing you can sort of list and label. So as month by month goes on, you're able to get a good understanding of your own personal finances. And this is what the banks are going to be looking at. So we've done a budget, okay? You feel like you've gone through your bank statements, everything makes sense, there's nothing untoward going on. Well, what these banks also need to see is a credit report, and they will do a credit check on you, okay? Now, there are a variety of credit reports available in the UK, and the top left and bottom right, they are free. Credit Karma and ClearScore are just some options that you can utilize to get an understanding of your credit report. Because it's all well and good that you've looked at the last 3 months of your income and your outgoings and the coffees and whatnot, but what about a 6-year period, right? Is there anything that you've maybe missed? Has there been any missed payments on anything that you didn't know about? You'd be surprised. Some standing orders didn't go out or direct debits didn't go out. In the eyes of the bank, they are going to use Equifax and Experian. They're the 2 big UK credit agencies that the banks will do a credit check on. And that will then show them your past 6 years of your credit. Now, the bottom left is Check My File. I typically recommend this to most people because it's a 30-day free trial. And also it compares Equifax and Experian and TransUnion in one report. So I'd always recommend, like I say, even in just personal budgeting and life, have a look at your credit report from time to time, see what's on there, make sure everything's in order. But the banks are going to do this anyway, so you need to make sure that you can see what they see. So let's say you've done your budgeting and you've got your credit report and everything looks good. We need to establish what the bank's thinking when we go to them for a mortgage. So I always like to explain it. Well, let's say that long lost, I don't know, you've got a third cousin, reliable Rachel. She comes to you and she asks for £500. Now, we know a little bit about Rachel. We know she pays her bills on time. All the direct debits are in and out properly. Monthly income's good. There's no missed payments and the credit card balances are low. So reliable Rachel, we would probably lend £500 to because we're confident we're going to get that back. However, we've always got that one person that we know, chaotic Carl. Well, we don't know what Carl's doing these days. His income comes in drips and drabs. We don't know what's going on. There's, credit card payments being missed all the time. He's always overdrawn. He takes out new loans regularly. Well, would you give £500 to chaotic Carl? Probably not. You're not too sure if you're going to get that money back. And that's how the lenders see it. They're going to be giving you a lot of money. They want to make sure that they're getting repaid. So always just think of it like that in your head. So you've got your credit report, you've done your budgeting, got your credit report. Then you need to get together some documents. So what is it that these banks need to see? And this is similar for first-time buyers. Like I say, seasoned homeowners, those looking to remortgage, they're going to want to see a proof of ID. They need to see who you are. Then they need to look at a proof of address. They want to see your income, whether it's 3 months payslip, or if you're self-employed, tax calculations and tax year overviews, also called SA302s. That's what they will be able to look at to establish what your declared income is over the last few years. They'll need to look at your bank statements, as mentioned earlier, direct debits, standing orders, big payments. That's what they're going to be looking at. And then if you're a first-time buyer or someone looking to move, they need to see that you've got an available deposit there, which we can talk a little bit later on in this presentation. So once we've got all those, we are in a perfect position. We're confident that we're able to start proceeding. So what actually are the options available to us? Well, first you need to establish what route are you going to take. So let's say you're a first-time buyer and you bank with, let's pick on Barclays. You approach Barclays and you want to find out what options are available. Well, Barclays can only offer the options that they have. They can't go to any other bank. It's just the options available that they have. Whereas with the broker, we compare all the banks that are available on the market, from high street banks to digital challengers, banks you've probably never even heard of, and specialist providers. That's where we come in. Barclays, let's keep picking on them. They provide basic advice and guidance based on their options. Again, it's more likely they're going to try, and this isn't always the case, but just kind of shoo you into an option that they have. Whereas we offer tailored advice. We have access to all these banks. So we could say in this instance, well, maybe Barclays isn't best for you. Maybe we could go to Nationwide or NatWest for argument's sake. They might not be able to offer support for your particular circumstance. You might have been chaotic Carl in the past and had bad credit. You may be self-employed. You may be a contractor and your income's slightly different to the usual vanilla stuff. Well, we work with specialist lenders and, in all niche situations. So we're always able to sort of tailor that and work out the best lender for you. You complete the application yourself if you go directly to a bank, whereas that's what we're paid for. That's what we do. We handle the paperwork, follow up with the underwriters and provide regular updates for you. It's typically not a personal service. You're kind of one of many. Whereas with a broker, well, we're your point of contact. We guide you from start to finish. Whether you're a first-time buyer looking to remortgage, moving home, buying a buy-to-let, we're guiding you throughout the whole journey. And rarely do these banks offer protection advice, which again, as I mentioned earlier, is really important. We advise you on life insurance, income protection, critical illness protection. You've got a big mortgage, you've got a big outgoing now. So we need to protect that. Touch wood, if something happened to a partner or a spouse, how are we going to be able to keep that property if the income's not coming in? What if one of you suffers a critical illness? How are you going to keep all the bill, keep paying all the bills? This is where these types of insurances come into it. So we've established that you're going to go with a broker. We now need to decide what sort of products are available out there. Well, there's a lot, okay? Again, from first-time buyers, those looking to remortgage or purchase a new home, there's so many different options available in the market. So for a first-time buyer, let's say you've got a 5% deposit, and that 5% deposit was gifted to you from a family member. That's one particular option and product. You could be someone looking to remortgage, you already own a home, and you want to raise some money for home improvements, let's say. Let's say you need a new kitchen or you need to do some work to the property. So that's a type of product. We will sit there and offer tailored advice to work out what the best option is available to you. At the bottom of the screen there, you've got a guarantor mortgage. So what some people aren't aware of is you could actually have someone else go on to a mortgage application with you, and we use their income as well. They don't own the property, it's just you, but we use their income to decide how much you can borrow on a mortgage. So there's so many options out there, and that's why going to a broker or going to a bank to get sort of specific advice on what you're trying to do is going to really help establish how you move forward from here. So we've established what products are available. Let's say we've got the first time buyer with a 5% deposit and someone who's remortgaging that wants to raise some money for home improvements. What's next? Well, now we need to establish what type of scheme we're going to go for. And again, there's a few. Okay, so for a first-time buyer, they might have a repayment mortgage. That means that they're clearing their mortgage as time goes on. They're making their payments, and slowly and surely that mortgage is being paid off. They may want to have a fixed scheme. As a first-time buyer, we might establish, well, we know they're going to be there for 5 years, so we want to fix our mortgage for 5 years. That means the mortgage payments are going to stay exactly the same for that 5-year period. But as you can see around that circle, you can actually have a variety of fixed periods. You could have 2 years, 3 years, 7 years, 10 years. Each person's circumstances is going to be different. But the person remortgaging, who's looking to raise money to, get a new kitchen fit, well, they may decide that they want a tracker option. Now, a tracker is different to a fixed. It tracks what we call the Bank of England base rate. So when the Bank of England base rate goes down, their mortgage payments go down. But if the Bank of England base rate goes up, their mortgage payments go up. Now, you may think, well, why would someone do that? Well, again, people are different. People have different risk appetites. So with a tracker, you could argue, well, if we are pretty confident that interest rates are slowly going to go down over the next 2-3 years, we may want to ride that wave. We don't want to be fixed into the option. We want to ride the wave and get that cheaper interest rate as time goes on. So there's always different situations, and that's why going to a broker to get tailored advice really is worthwhile. So we've established the product and what you're looking to do. We've established that, first-time buyer wants to be fixed for 5 years and the remortgager wants to do a tracker, for argument's sake. Now we need to get a AIP. Now, an AIP is an agreement in principle, also known as a decision in principle or a mortgage in principle. It's all interchangeable, same thing. Now, an AIP, imagine when you go onto a comparison site and you try and obtain a credit card, for argument's sake. You typically would have to do like a pre-check, pre-credit search, and it would then come up and say, well, your eligibility for XYZ credit is high or low. Don't bother with these guys. They're not going to offer you it. That is basically what an AIP is, a decision in principle. We've established a product, we've established a scheme. Now we're going to go to the bank that we recommend is best for you and do a pre-credit check. Now, on the right-hand side here is an actual agreement in principle that I had for a client not so long ago. We applied for this mortgage, but at the bottom, it actually declined. Aggregate credit usage was the reason. Now, it turns out they didn't budget too well and they didn't look at a credit report. So what they told me was actually very different to what was going on. So we went back to the drawing board, we obtained a credit report, and you could clearly see, and they weren't as aware either, that their credit was a lot higher than they thought. So it's important that we follow these budgeting steps before we apply for a mortgage. So we've established how we get mortgage ready. We've established what the various options are. What is the actual timeline? What's the process here? So let's take a first-time buyer for argument's sake, the 7-step journey to home ownership. So we've budgeted, we've reviewed our credit report, we gathered the documents, we've gone to a broker to get an AIP, a decision in principle, mortgage in principle, again, all the same. So we now know that we're in a good position to go out and get a mortgage. So we go to some estate agents, we view properties, and we put an offer forward. Now, an estate agent would typically ask for that AIP because they need to prove that this property you're looking to buy, can you actually afford it? And that's what an agreement in principle proves. So we've got our property, we've made an offer and they've accepted it. So the third stage there is you go back to your broker, tell them the good news, and the broker gets your full mortgage application submitted. Now, at this point, we also need to instruct a conveyancer, a solicitor, because some legal work needs to be done in the background to be able to purchase this property. Typically, that's what takes the longest time within this whole process. It's always going to vary depending on what you're looking to do. 8 to 12 weeks is a sort of typical time scale, but sometimes it could take 4 or 5 months. It's always going to depend on the property that you're buying and how big the chain is, how many people are selling and buying in that chain. So next step then, we've submitted our mortgage application and the bank now needs to do a valuation and underwrite the case. This is where the broker would provide all the bank statements, the ID, they do a full credit check, and they really establish who you are as a person. The underwriting process is then looking at your credit and documents and making sure that there is nothing untoward there and you are essentially reliable Rachel. They would also do a valuation. You don't organise that, they do. Let's say the first time buyer is purchasing somewhere for 250,000. The bank needs to make sure that, well, one, that property actually exists, it's not falling down. And two, is it actually worth £250,000? They're not going to lend you money if the true value is a lot lower than that. So they need to establish that and make sure that that's all done properly. So then the bank have done all their checks, they've done their valuation, they've done their underwriting, they're absolutely happy with everything. Then they issue you a mortgage offer. That is the stage where they're happy to confirm you are reliable, Rachel, we're happy to give you this money, we're confident that you're going to make the repayments. And that's when they issue this mortgage offer, which is confirmation that they're happy to issue this mortgage. So at this stage, the solicitor process really kicks on. You would have instructed them to work on your behalf. They request things called searches and raise inquiries, which is part of their legal process. So fast forward a few months, let's assume that that solicitor process has all gone swimmingly well. They've done all their searches, they've raised all their inquiries. Now you're in a position to exchange contracts. So this means you're basically there. You've almost purchased this property. So as the first time buyer, you pay your deposit. It could be that 5% deposit that we spoke about earlier. You may have a 20% deposit, 30% deposit. You may have been gifted your deposit completely. Again, all depends on the product that we're arranging. But at that point, contracts are legally binding. Everyone within the chain exchanges contracts, agrees to a completion date, and that's the end of the timeline. On completion day, the mortgage funds are released and you get your keys. Happy days. That is the first time buyer or home mover. It's exactly the same. So what about if you're remortgaging? Well, it's a slightly different process. We're still going to get mortgage ready. We need to still make sure that we look at our budget, review credit, gather our documents and make sure that we're in a good position. Now, when you already have a mortgage, let's say for argument's sake, you're in a fixed period, okay, and you've done a 2-year fixed scheme before. Well, 6 months before that expires, you can actually look to get a new deal sorted. And I always encourage to do it nice and early because your situation may be different. You may be looking to actually move home. You may be looking to, get that new kitchen or whatever it may be. You may be changing work. So if we get it done nice and early, we can account for any potential changes moving forward. But 6 months is the perfect time because when we obtain a mortgage offer, that is valid for 6 months. So what we do, we get mortgage ready and we do the budget, review the credit, gathered our documents. Now we get our agreement in principle. Now the broker may say to you, right, you're with Barclays and Barclays are still offering you the best option. So that's called a product transfer. We're just changing products. We're going from one fixed deal to another. Or the broker could say, well, actually Nationwide are the best option for you right now. So we're going to remortgage away from Barclays and you're now going to have a new mortgage with Nationwide. So we attain our pre-credit check with Nationwide to make sure that they're happy to accept us. Okay, so we submit the application with Nationwide and they do their assessment and their valuation. They do their affordability checks, they check all your credit, they do their property valuation. Okay, let's assume that's all good. Everything's added up there. There's nothing untoward, no issues. They then issue the mortgage offer. And again, depends on the situation that you have moving forward. If you stayed with Barclays, there isn't any need for a solicitor. You're not changing anything. You're just staying with the same bank. But if we go to Nationwide, well, we do need a conveyancer and a solicitor to do some legal work to move what we call a first charge, that's what a mortgage is, from Barclays to Nationwide. So there's not much that they need to do in all fairness to them. They obtain what we call a redemption statement, which basically means they're going to find out what your mortgage balance is at the time and make sure that Nationwide is going to lend you that same amount of money. So that's sorted. We then go to completion. So that's officially when the deal ends and your old mortgage ends and the new one begins. It's a slightly different process. But that's essentially the remortgage timeline. Hope you're still with me. So we've done 3 stages now. And the last and important stage is, well, what is this going to actually cost me? Well, again, it's going to vary quite a lot. So let's start on the first time buyer. Typically, people want a bigger deposit because that means their mortgage repayments are going to be lower. The smaller mortgage, the smaller the repayments. But you can have a 5% deposit, and depending on the product, some actually let you put down no deposit whatsoever. Again, it's always going to vary depending on your situation. Stamp duty. Unfortunately, we've got to pay some stamp duty. But as a first-time buyer, you're exempt under £300,000, and it's a sliding scale from 301 and higher. Now, these numbers always change. It's quite difficult to stay on top of. So I've put a link there to stampdutycalculator.org.uk. You can go on there and basically type in if you're a first-time buyer, home mover, or someone purchasing a buy-to-let property, for example. Put in the price, and it will tell you how much stamp duty is due. So lender fees now. This is mortgage related, and again, it's always going to vary. Barclays might have a valuation fee that you have to pay. It could be £100. You could go to Halifax. Theirs could be £50. Product fees are typically linked to mortgages. That's just basically the bank being a bit greedy, in all fairness. Some of them have no fees. Some of them could be 999. Some could be 2,000. Each product is going to completely vary. The thing with product fees, though, is that typically banks will offer 2 types of deals when it comes to their mortgage and their schemes. One will have a low interest rate with a product fee, and then they'll offer an option that has a higher interest rate with no fee. Well, that's where we come in as a broker. We establish what's the cheapest cost for you. We look at all the interest payable over whatever term it is, and establish, well, actually, it's worthwhile going for the option with the product fee because it's a cheaper interest rate, and overall the interest that you're paying is less than maybe the option without a fee. They may have an administration fee. Again, some might be free, some could be 200 quid plus. Each situation is going to vary, but that's why it's important for a broker to tailor the situation specifically to you. If you're chaotic, Carl, and you've had loads of issues in the past with your credit, you tend to find that these mortgage deals have slightly higher fees because, well, not all banks are able to help. Barclays, Nationwide, Halifax, they might turn around and say, not for us, unfortunately. Whereas a specialist lender say, no, we can do this. We can help you get a mortgage, but the fees are slightly high. You pay a slight premium for that. So then the solicitors. Typical purchase, this is always going to vary. You'd obtain a quote from a solicitor. Typically, you'd want to go with someone that you kind of know or you've had experience with in the past, or you know someone that's used them. That will always help, and their fees are always going to vary. I put 1,400 quid to 2,500. Again, it's going to vary depending on each firm. A survey, well, that can range. I strongly recommend you have a private survey when you're purchasing a property. The bank have done their valuation, but it's very, they don't cover too much. They have essentially worked out that the property exists and it's worth what you're paying for it. Whereas a private survey, what we call a home buyer's report, they'll go around, get on their hands and knees and really establish if there's any issues with this property that you need to know about. They might be able to establish that there's problems with the electrics or a problem with the roof. They would write up a report and say, look, you can proceed with this purchase, but just be aware of this. And then that's when you might be able to go back to the buyer or seller and say, well, look, we know we're going to have to change the roof or change X, Y, and Z in the next year. So we want a little bit of money off to cover that. Then you've got us, advisors and brokers, exactly the same thing. A bit like the agreement in principle, mortgage in principle. Advisors and brokers, they typically would charge a fee. And again, it's going to vary depending on who you go with. I've seen some people charge 395. I've seen some people charge £3,000. You need to establish, well, what's the difference here? Why is some person charging 395 and another 3,000? What are they offering at £3,000 that the other person isn't? And they could charge at various different points. Me, for example, I only charge what I call a lifetime fee, one upfront fee, and then any mortgage moving forward or purchase, I don't charge again. That's just how I work, but each person is different. So then home mover. So we've established you already own a home and you're going to sell, and now you've found a new place. Well, the equity is typically what's used as now your deposit, similar to a first time buyer, but you've got equity sitting in the property now. So what some people get confused about is that they think their equity is based on their current mortgage balance and what they had bought the property for. That's not actually the case. It's now what your mortgage balance is and what the current value is. So if the current value is 250 and your mortgage is 200,000, your equity is 50 grand. That's quote unquote your deposit. So if you sold, you take that 50 grand and use that as your deposit moving forward. Stamp duty is slightly different. It's more favourable for first-time buyers, but for home movers, you're exempt under 125,000. And then again, it's a sliding scale from 126. Click on that stamp duty calculator. Let's go back. That stamp duty calculator, and it'll be able to explain more about what those charges are depending on the property price. Same situation with first-time buyers. Valuation fees, product fees, administration fees, they're always going to vary, and the broker's going to help establish what they are, how and when you pay them. These product fees can be added to a mortgage. So if you obtain a £200,000 mortgage and it's got a 999 product fee, we can actually add it onto the mortgage instead of you using your savings to pay for it. Solicitor, now you've got a slightly bigger job. You're selling and buying, so the solicitor process is slightly longer and the cost could be higher. Again, you're buying somewhere new, so you want a survey done, and then you need to establish, well, what's our advisor going to charge you? Is it a lifetime fee? Do they charge each time? What's the situation here? Now we're remortgaging. So again, the equity is your deposit. So that's what the bank uses. You don't have to put down further money. They use the equity in the property as quote unquote deposit. There's no stamp duty. You're not buying a new property now. That's the only time you'd pay stamp duty. So there's no fee to pay there. Again, lender fees, it's always going to vary. Now, the difference with a solicitor in this instance is, well, they have various options. The mortgage market is very, very competitive. So let's say that you wanted to stick with Barclays. Nationwide have got a better option, but we've got to pay £1,000 to a solicitor to do it. Well, you probably wouldn't. You might think, well, actually, I'd rather just stick where I am. Well, that's where Nationwide say, well, actually, we're going to be competitive here and we're going to pay for your legal costs. And these banks do that quite a lot. They're trying to encourage you to go to them. So they may pay for your solicitor costs, or what they can do is offer cashback. And cashback basically means is you pay the upfront cost for the solicitor, but we'll refund you. It could be £500, £300. Basically, we don't want this to cost you any money, but we want your business. We want you to come to us Nationwide. Survey, well, again, you're not buying a new property, you're staying where you are. So there's no cost for a survey. And then for the advisor and broker fee, again, it's going to vary each time. So a bit like solicitors, maybe go around and get a few quotes, work out what people are willing to charge. Same with a broker. See the difference between one person and another. So hopefully that makes sense and you're still with me. Now, typically when I'm dealing with clients on a day-to-day basis, I'm asked sort of the same types of questions. So I've included these here. So hopefully it will help you understand, if you maybe had this question in your head, how it works. So how much deposit do I need? Well, again, let's say you're a first-time buyer. Maybe a 5% deposit is all you need. Maybe you could put down 15%, 20%. It's going to vary. You could be given a massive gift from family. You could have had some inheritance. Each situation is going to be different. How much can I borrow? Well, again, this varies massively as well. For first-time buyers, a lot of banks have what we call like lending boost affordability. If you typically earn sort of 35, 40 grand or more, they might say, well, we're going to give you 6 times your income. On average, most banks let you borrow 4.5 times your income. So that's whether you're buying on your own or buying with a partner. Combine your gross salaries times by 4.5, and that's typically what you can borrow. But again, some of these lending boosts for first-time buyers could do 6.5 times your salary. Some banks where you're remortgaging to might do 5.5 times your salary. Each situation is going to be tailored to what you're looking to do. Should I remortgage now or wait for better rates? Well, I mentioned earlier that you should always do it 6 months before, get an option ready 6 months before your current deal ends. So really, that's the time that you should start looking properly and getting a deal on the table. Now, with brokers, what we do is we get you the best deal. That's now on the table. We haven't got to touch that now for 6 months because your current deal is still going to be in the background running until 6 months' time. Well, let's say again, let's pick on, I don't know, Nationwide. Nationwide reduced their interest rates in that 6 months. Well, then I'll go to Nationwide and I'll secure you a cheaper deal. And I can keep doing that up until the time that the 6 months expires. So then at the day after the expiry date is when your new mortgage kicks in. So the earlier you start, the better chance you've got at securing a good deal. Because you can't go back in time. If you decide, well, I'll just wait until I'm 2 months or 1 month before my fixed deal ends and interest rates have gone up, well, you've lost out. You might as well start nice and early. And if interest rates go up in that 6 months, well, you're not impacted. We've already got an option on the table. So start early. Are there any penalties or fees if I switch early? Well, again, each situation is going to be different. Ideally, in most situations, we don't switch you early. We switch you the day after your fixed deal ends. So there are no penalties there. But it could be a certain circumstance where it would make sense to switch early. Again, tailored advice is going to help understand what's best for you. And this is a big one. Can I move a house before my current deal ends? Yes. And what a lot of people don't realize is that there is such a thing called porting. Porting basically means, let's assume our first time buyers moved into their house, they've done a 5-year fixed deal, but after 3 years, they just don't like it there. They want to move. So they've still got 2 years left of their fixed deal. Well, typically, if you repay that mortgage, sell the house, you'd have an early repayment charge because you agreed with the bank you'd have this for 5 years, but you've only had it for 3. So they charge you a fee. However, we can get around that and say, well, we're going to pick up our existing deal that still has 2 years left or 3 years left, and we're going to move it to this new house that we want to purchase. That's essentially, that avoids an early repayment charge. Not many people are aware that that is possible. And it basically just, you keep paying the existing deal. And if your house that you're buying is worth more, then you kind of top up the existing mortgage with a new one. So again, that's a big one. I help a lot of people move house early or within their fixed deals, and get them to avoid paying any sort of early repayment charge. So hopefully that makes sense. Obviously, welcome any questions that you do have. Here, I've tried to be a bit fancy with the QR code. So if you've got your phone, you can scan that and hopefully my name comes up with my email address and phone number. So if you're ever in a position where you're not too sure about your circumstances or not too sure what your options are, or want to discuss, if you're a first-time buyer, discuss the options that you've got moving forward, then feel free to get in touch. You can drop me an email, you can drop me a call. I think my LinkedIn is on there as well if you need to get in touch. So yeah, give that a scan, and then hopefully if you've got any questions, I can answer them for you. But that's the presentation. Oh, sorry, I was going to say that's the presentation, and yeah, welcome any questions.
Thank you, Darren, for such an insightful session. We've had lots and lots and lots of questions. I have been struggling to keep up, but if we have any other questions that people might have that they've been holding on to, please feel free to type your questions into the chat box. We'll try and go through them one by one. I've tried to answer a few of them as we've been going, and tried to sort of group things together as best I can. And just to say that, if we're not able to get through all of your questions, because we have really had quite a lot, what we will do is we will follow up with an email with sort of the questions that we don't get round to. So anything that's on your mind, whether it's about starting your home buying journey, any next steps, if you're maybe remortgaging or looking to move house, any sort of tips and tricks that you want to ask of Darren, or anything you want Darren to expand from on the session, Darren would love to hear from you. But I will start off with some of the questions that we have had, so bear with me.
Fire away. I don't know if it's good or bad that we've got lots of questions.
It means that it's been a really engaging session, so hopefully it's a good thing. There might be a situation where we might have to take some of these questions and potentially look at doing some other sessions with Darren, so bear with us if we don't get to everything. So one of the questions that we've had is, does applying for a mortgage and then not going through with it affect your credit score? So this is where someone's actually changed their mind about buying a property. So they've applied for the mortgage, then decided not to go ahead. Is that likely to have an impact on your credit score?
So typically, no. It's a bit of a myth when it comes to credit scores. Banks are looking at your credit history more so than your actual credit score. As I mentioned with those credit reports earlier, each credit agency will have their own different score, so they always vary anyway. But essentially, no. If you apply for a mortgage and you back out, you may have paid a fee at the beginning. It could be your advisor fee, broker fee, any fees that the solicitor would need up front. But other than that, no, backing out the mortgage is not going to cause you any issues.
Wonderful. Thank you for that. So we had a few questions around brokers, so I might try and group some of these together as best I can. And I'm really sorry if I miss individual questions off, because I've been trying to collate them and group them. But we've had a few questions around how transparent should you be with your mortgage broker, mindful that they can only go off the information that you give them. So obviously the more open, the better. However, there was a recent Panorama documentary where a broker was working with an agency on conditional selling. So the applicant's finances were sort of more exposed. And then sort of a follow-on question to that is, how do we know that the broker recommends the best available option for us and doesn't have conflicts of interest when making recommendations?
Great questions. Okay. So I'm going to be biased because I am an independent financial advisor, right? I'm what we quote whole of market. There are different types of advisors and brokers out there. I know what documentary you're talking about, and there has been some in the past as well, where maybe some of these sort of big estate agencies have advisors or brokers in-house. You need to find out from them if they are quote unquote whole of market, or if they're what we call a tied agent. A tied agent basically means they only have access to 5 or 10 different lenders, for argument's sake. Whereas whole of market, we're whole of market. We can access every single bank and building society out there. So I think if you're going to go to a broker, you need to establish first and foremost, can they access every option out there? And the beginning of that question was being transparent. 100%. You need to be completely transparent. Otherwise, it's only a waste of your time. If you pretend that your debts are all aligned and there's no issues here, or your deposit is okay, but you don't need to see it, and then a broker starts working on your behalf and these things come to light, it's only going to affect you. We can't get you a mortgage now, right? So the broker needs to fully understand your circumstances. They need to fully understand where your deposit's coming from, because we're sort of like that first guard before we apply to the mortgage. So in many instances, I'll have people come to me that tell me a variety of things, and I'll know straight away, right, we can't go to Nationwide because, well, they're going to need to see X, Y, and Z, and you just don't match that criteria. Whereas if we go to Halifax or a different option, that's going to be more suitable for you. So always be completely transparent.
Wonderful. Thank you, Darren. And just still on the subject of brokers, so there was quite a few questions in the chat around kind of, is it normal for a broker to request money? Some brokers earn commission from the bank, but also for others, there's a charge. There was a question around sort of best practice. We were talking in the chat about getting a few quotes from different people just to see what's out there. But is that likely to have a financial impact? Are you paying for that advice? So kind of how does it work? What should people look out for to make sure that they're kind of getting kind of the best advice?
Best advice. Exactly. So each advisor or broker, I'll kind of say them interchangeably. I'll explain why I say advisor. So typically, an estate agent advisor that's tied, we class as an advisor. That's not always the case. A broker is typically mentioned as someone that's whole of market. So always double check that. But I refer to myself as a broker. I can broker deals from a variety of different banks. So where do we start with that? Each broker is going to have a different fee, and they need to establish straight away when that fee is payable. Some of them will be payable right at the beginning of the process. Some may be payable when we submit a mortgage application to a bank,
Hmm.
because there's still a lot that we need to do to get to that stage. So we charge a fee for our time, essentially. Or some may charge a fee when we've officially got a mortgage offer, because we know the mortgage has been approved at that point, nothing can go wrong. Then we charge a fee. Each advisor is honestly completely different. If you speak to two or three different brokers, advisors, just ask them, when is it that you charge me? And what happens if I pull out? What happens if something goes wrong with the mortgage or the house that I'm looking to buy? Something goes wrong. Am I going to lose that money? Do I get refunded?
Hmm.
Again, it's always going to vary. Um, but yeah, it's each person's situation is different. I personally charge when I submit an application. I've done a lot of work prior to that, so I charge my fee on application. But again, I charge a lifetime fee. There's no further fees from that point onwards. Whereas other advisors or brokers may charge every single time you need a mortgage, each to their own. It depends what they want to do. But when we apply for a mortgage and it completes, we do get some level of commission from the lender. And again, when you're when the broker's being transparent about their fees, they would say that. They would say, look, we charge X amount fee up front, and then when it completes, we get X amount from the bank. And those numbers will always vary as well.
So really kind of the rule of thumb there is to ask the question up front, be very clear about the question that we're asking, but also just kind of to do your research and make sure that the person that you're using is regulated to provide that advice and is providing sort of the correct advice.
Yeah, 100%. There is no harm speaking to two or three different advisors or brokers, but you could have it where you've actually picked three brokers that are whole of market, and when you speak to them, they recommend the exact same mortgage, right? So then you've got to kind of weigh up, well, who do we like? Who do we
Yeah.
trust? Who are we able to be transparent with? So, but the broker's not just there. Obviously, we're there to get a good deal for you, and that's what we're paid for. But we are kind of like that person that holds your hand throughout the journey, whether you're a first time buyer, whether you're remortgaging or moving house or buying your fifth buy to let property. We are there to help pull in the variety of sources, from solicitors to the mortgage stuff to everything in between. So we kind of pull the strings to make you understand the process, and we're always that one point of contact that you can speak to work out what's going on. Solicitors are notoriously known for being a little bit difficult to deal with. The sort of solicitor jargon, shall we say, can be a bit confusing. But if
Yeah.
you've got me there to be on your side and guide you through the process, I can explain how this all works. And I've been asked a billion questions from first-time buyers, and everyone always says, "Oh, this might sound stupid or whatnot." It's not. We've heard it all a million times. If you've never done the process, how would you know any different? So just be open, transparent, and honest. And if you've got any questions, if your broker is worth their salt, they'll be able to just sit down with you and explain what's going on, explain the next steps.
Perfect. Thank you, Darren. We've had a few questions around sort of first-time buyers buying with partners or people that have previously purchased a property. So I'll use one of the questions, but I think it will answer some of the other questions we've been asked as well. So I'm a first-time buyer with limited credit history. My partner's previously purchased a property and plans to sell, and we plan to buy together. How would our joint purchase affect our credit scores and stamp duty? Just to caveat that we're not going to be giving specific advice, but sort of broadly speaking, we can probably cover the topic of a first-time buyer purchasing with someone who's previously owned a property before, and what the impact of that is to both stamp duty and joint credit scores.
Yes. So one thing that banks will look at is on your credit report if you're financially linked to someone. And that can be quite big because you could be you're reliable, Rachel. You've got a perfect credit score, perfect situation. You're budgeting well. And it just so happens that your partner's not great with their finances. They're chaotic Carl, right? And if you've got a joint bank account, that link can unfortunately bring reliable Rachel down because that bank is lending you money jointly. And they would be a little bit nervous that chaotic Carl is going to be a bit chaotic. So that's something that you need to be aware of. It's not necessarily that it brings your credit score down. Again, the main thing you need to focus on is your credit history. When you go to these credit agencies, look at what your payments have been over the last 6 years. Your credit score will always fluctuate. If you open a new bank account, if you take out a new credit card, you might lose a few points. That is not their concern. Their concern is you've been making your payments for the last 3, 4, 5 years, and there's no issues there. So that's what they're looking at. In terms of the stamp duty, a little bit harsh. If you're first-time buyers and you're both first-time buyers, then there is no stamp duty. Again, on that graph, up to a certain limit. If one of you is a first-time buyer and one of you is previously owned, then you're not entitled to the free stamp duty. You pay stamp duty on your purchase moving forward. So unfortunately, you do lose out on that sort of first-time buyer status if you're buying with someone that isn't a first-time buyer.
Brilliant. Thank you for that. So it's probably actually one of those things that if you're on that journey and thinking of those additional costs that you might need to factor in as part of buying a property, to kind of have that at the front end to feed into your whole sort of home buying or home moving budget, as it were, that actually you're potentially missing out on that sort of cap of the 300,000 for first time buyers. Just a quick follow-up question that's literally just come in now. I think it's around the joint sort of credit history. So the joint credit file. How can you remove that link?
That's difficult because it depends what sort of financial link you have. So if you're a couple, you've been a couple for a while, most people would have sort of a joint bank account. So you'd have to kind of remove that element. You both have your own individual finances, but at the end of the day, if you're buying together, then a credit check is going to be done jointly anyway. So you can't exactly avoid that. But let's say it's an ex-partner of some sort that you're no longer with and you don't want to be financially linked to them. Go through your credit report. You'll be able to see on there, it will say financial links, and maybe it could be an old bank account that you forgot about. Get your name, go to that bank, get your name removed from that, and then you'll release that financial link from them. Wonderful.
Thank you. So we've had a few questions about the Help to Buy ISA as well. So we've had a question around if I've got a Help to Buy savings, I'm going to assume that's the Help to Buy ISA. Can I buy a property and rent it out? My understanding is you can't do that with the Help to Buy ISA.
Well, is
there a grey area?
There's two different parts to this. You've got the Help to Buy scheme and the Help to Buy ISA. They are not technically linked. The Help to Buy scheme, when you purchase a property where the government give you a 20% boost, they aren't available anymore. They've stopped them. But the Help to Buy ISA is essentially just a platform, an ISA for you to save money, and you get the little bonus depending on how much you pay in, and then you use that solely for the purchase of a property. So if you use the Help to Buy ISA, you purchase a property, you live there for 5 years, and then you decide now we want to rent it out, not a problem. The Help to Buy ISA was just a deposit that got you onto the ladder there. So again, it does kind of vary depending on circumstance.
Brilliant, thank you. And I'm just trying to find my other question about the Help to Buy ISA. Please bear with me 1 second, because we've had a couple, and I think it was around whether you can use the Help to Buy ISA to pay towards the deposit of the property, or whether it's just the capital within the Help to Buy ISA that you can use, but not the government bonus.
No, it's lumped together. So the Help to Buy ISA is essentially solely for the deposit. So however much money you've put in, and then the government bonus is added on top, that total sum is what's used towards your deposit to purchase a property.
And is there any sort of recommendation of how soon you should start looking into kind of the Help to Buy ISA and kind of the funds and how that all works? Or is that best to sort of have that very transparent conversation with your broker or, you know, your lender who will kind of talk you through that process?
Yeah, I mean, there's no harm opening a Help to Buy ISA, putting £1 in or whatever the minimum is to get it open, and then start saving as much as you can. You know, yeah, you can be transparent with a broker. Just because you speak to a broker doesn't mean that something's going to happen there and then. Again, a broker worth their salt would maybe put a plan in place to say, look, you're not ready yet, you've not got a deposit available yet, but if you use a Help to Buy ISA and you put X amount in there for the next 12 months or 24 months, then yeah, you're going to have a good deposit available. And then they can work the numbers based on what sort of purchase price you're looking at, and therefore how much deposit you would have had in your Help to Buy ISA at that time.
Right. Thank you. We've had a couple of questions from people around sort of being first time buyers sort of later on in life. I think we've had a couple of questions around 40s and 50s and being a first time buyer. Is there an upper age limit to getting a mortgage? And kind of, you know, when you're more mature, are there any other challenges that you might face when trying to get a mortgage or being a first time buyer?
So mortgage lenders are surprisingly very flexible, right? Because when you go to a broker, because we have access to so many different lenders, each one's going to have their own criteria.
Mhm.
I've had first time buyers that are 50 and 60, right? There is no upper limit to being a first time buyer. What it does mean is your mortgage term, the period that you have your mortgage over, would be a little bit shorter, but you could still have a mortgage until age 75, age 80 if you really wanted to. Some can take you to age 85. You know, that's doesn't necessarily mean that's a good thing to do. And that's why speaking to a broker to give you advice on that works. You could be someone that, I don't know, a young footballer that may have a 40-year mortgage term, but get big bonuses and they know they're going to pay off chunks of their mortgage as time goes on. So then we can bring that term massively down to when they retire in their 30s, whatever it may be. Each situation is completely different. But the lenders are flexible, and because there's so much competition out there, there is typically always a bank or a lender willing to provide an option. But just think realistically, if you're a firefighter and you want a mortgage until your age, I don't know, 80, is that realistic? Are you still going to be up and down a ladder and fighting fires at age 80? And that's how the bank's going to look at it. Is this reasonable? Or are you someone that's got a desk job and realistically you do think you could work until age 75? Well, that is more realistic. And that's how they look at it. But just because you take out a long mortgage term of, let's say, 40 years to begin with, doesn't mean we can't reduce that over time. We could start at 40 and then 5 years down the line, income has increased, your personal circumstances are better, and we're able to knock 5 or 10 years off your mortgage. So you clear it 5 or 10 years earlier. It can always change. It can always vary.
Excellent. Thank you, Darren. I'm really conscious of time, and I know that we've got lots of other questions and there's more questions coming through. So I'm really sorry if we've not answered your question in the session today. We will collate them. We'll try to get something together. We'll see if there's a common theme and if maybe we need to have a standalone session. But I just wanted to thank you all for your participation this afternoon, and for all your questions, all your really thoughtful questions, comments, and some tips and tricks and things that people have been putting in the chat to help others. Hopefully it was an hour well spent. Before we conclude, I just wanted to ask everyone if they can to fill in the quick 2-question survey that we've popped into the chat, because your feedback is really important to us. And any additional comments, suggestions, or if there's any specific sessions that you think might be beneficial for us to host in the future, please pop those in there. Our next financial wellbeing webinar in the series will take place on Thursday, the 25th of September at 12. and it is all around pensions. So it's about securing your future, and it's the essential guide to pensions. So that's another opportunity to ask questions around pensions this time, and we'll confirm all the details shortly. We do look forward to seeing you there as we continue to explore all the different ways that we can improve our financial well-being in a holistic way. We will automatically send out invites to all of you that were on today's session. However, if you do want to opt out of receiving those invites, just let us know by return email. So once again, thank you all so much for joining us, and I hope you have a lovely afternoon. Thank you. Take care, everyone. Thanks, Darren.
Cheers. Bye.